Caleb Danner applied for a $50 loan, not because he needed it, but to test how the bank treated ordinary working people. Branch manager Todd Vickers didn't read the application. He saw a worn jacket and dusty boots and dismissed the man in front of him. He tore the form in half in the lobby, told Caleb he was wasting everyone's time, and called security. Caleb didn't raise his voice. He placed 12 account cards on the counter and said, "Then close all of them." The total balance was $60 million, and that was only the beginning. If you're here for stories where the arrogant finally meet their reckoning, hit subscribe now and stay with Caleb all the way to the end. The morning Caleb Danner walked into the downtown branch of Wycliffe Commonwealth Bank, he had already been on his feet for 3 hours. He had driven out to a warehouse project on the eastern edge of the city, where a crew was replacing the loading bay flooring, stood in the cold while the site supervisor walked him through the delay, and left with sawdust still on his jacket and a thin film of machine oil on the back of his right hand. His truck, a 12-year-old work model he had bought used and never found reason to replace, sat in the visitor parking space between a leased luxury sedan and a clean SUV with dealer plates. Nobody in the parking lot would have guessed that the man stepping out of the battered pickup had more money moving through this bank than most of its branch managers would earn in their combined lifetimes. He answered a call from Owen Rusk just outside the entrance. Owen was 58 and had been with Danner Holdings since the company owned 3 trucks and operated out of a rented garage. He knew the accounts down to the last decimal and had a habit of stating facts plainly, without decoration. He reminded Caleb that the bank was still waiting on authorization to move forward with a new arrangement, one that would bring the payroll system for more than 2,000 employees, an operational reserve fund, 2 real estate development accounts, and a commercial freight credit line all under Wycliffe's management. Caleb told him to hold everything until he finished one thing first. Owen asked no questions. He had worked with Caleb long enough to know that when the man said one thing first, it usually meant something the suits in the main office would not see coming. Inside, the branch was polished and bright in the way of a place that spent money on appearances. A large banner stretched across the far wall with the words "Fresh Start. Everyone deserves a second chance." Caleb read it twice, then walked to the counter and asked for a loan application. The product had been described to him in a pitch meeting 3 weeks earlier as a community initiative. Small amounts between $50 and $500, available to working people who wanted to rebuild their credit history. No collateral required. No employment minimum. The bank had recently approached Danner Holdings about rolling the program out to its entire workforce, and before Caleb agreed to let the bank's name reach 2,000 of his people, he intended to understand what that name was actually worth at street level. The teller who handed him the application was a young woman named Millie Crane, who explained the form carefully, offered a pen, and pointed to the section requiring a basic income summary. She was polite without being condescending, and Caleb noted that. He filled in his home address, a modest house in an older neighborhood, where he had raised his daughter since his wife Rebecca died 4 years earlier from an illness that moved faster than any of the doctors had prepared them for, and listed his personal income from a small consulting arrangement he kept separate from the corporate structure. He did not include his ownership of Danner Holdings, because the form did not ask for it, and because the entire point of the exercise was to walk through the door as the kind of person the bank had told the public it wanted to help. Before he finished the second page, he noticed a woman in her 60s come out of the branch manager's office, with her coat gripped tight at the front and her eyes red. He recognized her as Joanne Bell, mother of a man who had once driven long haul for one of his freight divisions. The branch manager stepped out behind her, straightened his jacket, and said something quiet to a nearby teller that carried just far enough across the lobby. Those kinds of files are nothing but a drain on the afternoon. Caleb watched Joanne push through the front door without looking back, and he set his pen down for a moment before continuing. Todd Vickers had the build and posture of a man who had spent 20 years believing a branch manager's office was the center of the financial universe. He was 48, kept his suits pressed, and had a handshake he reserved exclusively for people whose account balances he already knew. When he picked up Caleb's completed application from Millie's station, he did not read it. He looked at the boots first, then the jacket, then up at Caleb's face, with an expression that carried something close to theatrical patience. "You're telling me," he said, "you came all the way down here to borrow $50. Todd did not invite Caleb into a private office. He stood in the middle of the main floor, where anyone in the lobby could hear him, and began asking questions that had no business being asked out loud in front of strangers. He wanted to know what Caleb did for work. He wanted to know how a grown man couldn't cover $50 on his own. He asked whether Caleb was currently living in his vehicle, using a tone that suggested the question was reasonable. He asked whether there had ever been any fraud charges. He said the Fresh Start program wasn't designed for people simply looking for a handout, and when Caleb pointed out that a loan with interest and a signed repayment agreement was not a handout, Todd shifted to a different register. The one he used when he had already decided the conversation was over and was simply performing patience for the benefit of anyone watching. Caleb told him that everything the bank needed was in the file. Todd had not opened the file. What changed the temperature in the room was the arrival of a man named Lyle Garrett, a commercial real estate investor, who had known Todd since they coached youth soccer together a decade earlier. Lyle came through the front door still talking on his phone, and the effect on Todd was immediate and total. The expression of theatrical patience disappeared. The shoulders dropped into ease. Todd crossed the lobby in 6 steps, extended his hand, laughed at something Lyle said before the call was finished, and offered coffee. To clear the space and finalize the performance, Todd picked up Caleb's application, still unread, and tore it in two. Not dramatically, not with anger, but with the casual efficiency of someone discarding a receipt they had no intention of keeping. He set the pieces on the edge of Millie's station and said, loud enough that it reached the chairs by the window, "A man who needs to borrow $50 isn't the kind of client this branch is built to serve." 2 or 3 people in the lobby turned. Millie looked at the torn pieces and then at her screen, and she did not look up again for a long time. A security guard appeared at the edge of Todd's peripheral vision, ready and waiting. Caleb stood still. He asked, without raising his voice, whether Todd would be willing to put the reason for the denial in writing. Todd smiled, not warmly, and said, "You never had a file worth denying." He gestured to the guard, and Caleb took 1 step back, which was all the guard needed to understand that an escort was expected. Caleb paused near the waste bin beside Millie's station. He looked at the torn halves of his application, and below them he could see the edge of other papers, other forms, folded and discarded in the same bin, visible to anyone who passed. He took out his phone and called Owen Rusk. He said, "Stop everything on the new agreement. Pull together what we need to close all 12 accounts." Todd was watching from the corner of his eye, still standing with Lyle, and the slight curve at the edge of his mouth suggested he believed Caleb was doing the only thing a man in his position could do, pretending to have leverage he didn't have. He was still smiling when Caleb walked back to the counter. From the inside pocket of his jacket, Caleb removed a thin leather holder and laid its contents on the transaction counter one at a time. 12 cards. Each one was a business account confirmation, not personal, not small, not symbolic. They represented Danner Freight Operations, Danner Civic Properties, Danner Warehouse Group, the Rebecca Community Foundation named after his late wife, 4 project-specific holding accounts, 3 operational reserve funds, and the primary payroll disbursement account that moved money to over 2,000 working people every 2 weeks. He placed each card face up in a clean row, and when he was done he requested, in writing, calmly, clearly, that all 12 accounts be closed, that the balances be transferred by wire to a receiving institution, that all cash management services be terminated, and that the pending payroll contract under review be formally withdrawn. He asked for written confirmation of each step. Millie looked at the names on the cards. She typed the first account number with the careful movements of someone who already suspected the screen was about to tell her something she wasn't prepared for. The system loaded, and what it showed stopped her hands completely. A single line under the primary account holder's name read, Caleb Danner, Chimery Off-Force Ogre. Beneath that, in figures large enough to leave no ambiguity, the total relationship balance across all linked accounts was $60,214,870. Millie sat very still. Then she reached for the extension line to the private banking team. Todd moved across the floor fast, the way people move when they understand that something has exceeded their ability to manage alone. He leaned over the counter, took in the screen, and pulled the keyboard toward himself, as if verifying the number would somehow change it. It didn't. The private banking desk rang the branch directly within 90 seconds, asking why a strategic relationship client of this magnitude had just submitted a full account closure request. Todd asked everyone nearby to give him a moment. He told the phone that there had been a misunderstanding and that he was handling it. Then he turned to Caleb with a voice that was working very hard to sound the way it had not sounded 5 minutes earlier. He called him Mr. Danner for the first time. He suggested they step into the private conference room, where they could speak without any confusion. Caleb looked at the waste bin, at the torn halves of the application, at the edge of the other discarded forms visible beneath them, and he shook his head. "You understood exactly what you were doing," he said. "You were just wrong about who I was." It was a composed statement, not a threat and not a performance, and it landed in the lobby the way quiet things sometimes do, heavier than anything shouted. Somewhere in the building's internal alert system, a flag had already been generated and sent upstream. At the headquarters of Wycliffe Commonwealth Bancorp, the office of CEO Eleanor Wycliffe received a notification marked urgent, $60 million relationship at immediate risk of full closure. Todd's transformation was not subtle. Within 4 minutes of seeing the account balance, he had offered water, moved to use Caleb's last name, attributed his earlier behavior to the stress of a heavy quarter, and suggested that the torn form had been a draft rather than a real document. He said he had been planning to discuss an alternative product, something even better suited for what Caleb needed. He offered to approve the $50 loan immediately with all interest waived, and said it twice, as if repetition would retroactively change what had happened in the lobby 10 minutes before. Caleb declined to move to the private room. He said that every conversation he intended to have would take place in the same space where Todd had made his opinions public. Todd looked at the people still watching from the chairs near the entrance, and his jaw tightened. A video call came through to the branch's conference screen from Nathaniel Crow, the regional president. Nathaniel was 56, silver-haired, and carried the practiced calm of a man who had spent 3 decades learning to make difficult situations look like administrative procedures. He described Todd as a valued employee with a long record of strong performance. He offered Caleb a full year of fee-free account management, placement in the bank's preferred private client tier, a formal written apology delivered within 24 hours, and asked Caleb to delay the account closure decision by 48 hours so that the institution could respond appropriately. Caleb asked whether Joanne Bell, the woman he had watched leave the branch manager's office with red eyes earlier that morning, would be receiving any similar offer. Nathaniel did not know who Joanne Bell was. Caleb then explained, evenly, why he had applied for the loan in the first place. The bank had approached Danner Holdings about bringing the Fresh Start program to its entire employee base: mechanics, drivers, warehouse workers, logistics coordinators, people who earned hourly wages and for whom a $50 shortfall at the wrong moment could mean a missed utility payment or a late fee that started a downward cycle. Before extending that introduction, he had come in as one of those people to see what the experience actually was. The file had not been read. It had been torn apart in front of bystanders and dropped in a bin. Nathaniel said the behavior of one branch manager was not a reflection of the institution as a whole. Caleb said, "A manager only does this in the middle of a lobby when he's certain the system around him will not object." Nathaniel started to answer, and the front door opened behind him. Joanne Bell had come back. She had forgotten her gloves on a seat near the entrance and returned to retrieve them. She saw Caleb standing at the counter and stopped. She recognized him from company events years earlier, from the memorial service held after her son left the freight division, and she hesitated, then walked toward him and said that the manager in the back office had done the same thing to her 6 weeks ago. He had torn her application before even looking at it, then handed her a business card for a lending company she had never heard of before that day. Caleb asked Joanne to tell him exactly what had happened, and she did, without embellishment. She had come in asking to borrow $400 to repair a failing heating unit before winter set in. Todd had not run a credit check. He had not entered her information into the system. He had looked at her address, a working-class neighborhood on the south side, and said the Fresh Start program had specific eligibility criteria he would need to review before proceeding, then handed her a business card for a company called Bright Path Emergency Lending and suggested they might be more flexible. The $400 loan from Bright Path had come with a fee structure that pushed the total repayment above $1,300 over 10 months, secured against her car. The only asset she had besides the house, and she was now behind on the repayment schedule by 6 weeks. Caleb listened. He did not interrupt. When she finished, he looked at the waste bin next to Millie's station and noticed for the first time what was underneath the torn halves of his own application. More papers, more forms, torn or folded, and discarded in the same open bin, not shredded, not filed, simply thrown away. Maren Holt arrived at the branch before noon. She was 43, the bank's director of compliance, and she had received a direct instruction from the CEO's office to assess the situation before it escalated further. She walked in, evaluated the room in about 12 seconds, and immediately issued a set of instructions that no one in the branch had authority to override. She told the security staff that no one was to touch the waste bin. She asked for the camera archive from the previous 6 hours to be locked. She ordered Todd's system access credentials suspended pending review and requested that every loan application initiated that day be preserved in its current state, with the branch remaining open until a full inventory was complete. Todd said the papers in the bin were scratched documents and internal notes. Maren pointed out that several of the visible forms contained handwritten signatures, social security numbers, and personal financial information. Discarding them in an unlocked, open-top bin in a public-facing area was a violation of federal data security standards, regardless of whether the applications had ever been formally submitted. When Owen Rusk arrived with the legal documentation to authorize the wire transfers, Todd finally understood that the account closures were not a threat. They were an action already in motion. He watched Owen set a folder on the counter and speak quietly with Millie about the sequencing of each transaction, and something in his posture changed. The last remaining traces of condescension left him, replaced by something closer to calculation. Maren, meanwhile, had begun examining the discarded forms more carefully. Most of the identifiable applicants shared a profile: retired individuals, hourly workers, veterans on fixed incomes, residents of 3 specific zip codes on the south and east sides of the city where average household income sat well below the county median. Next to several of the forms, in handwriting that matched the branch manager's log style, was a 2-letter notation, B and P. Joanne reached into her coat and handed Maren the business card she had been given 6 weeks earlier. The name at the top read Bright Path Emergency Lending. The registered agent on the state business filing for Bright Path Emergency Lending was Todd Vickers's brother-in-law. Owen had anticipated the question Caleb would inevitably be asked, the one about how $60 million physically left a bank branch, and he had prepared a simple explanation. The money did not move in bags or dramatic armored deliveries. It moved the way serious money always moved, through properly authorized wire transfers, each logged, each confirmed, each time stamped by both the sending and receiving institutions. The payroll account went first, transferred to a community bank that Danner Holdings had worked with on a neighborhood revitalization project 3 years earlier. The operational reserve funds followed through the morning. The project holding accounts were staged to close after any outstanding checks had been reconciled and cleared, which Owen had already coordinated. The first outgoing wire, $8 million, triggered an internal liquidity alert for the regional division. The bank was not in danger of insolvency from the loss of a single relationship, but the institutional consequences were substantial and immediate, in a way that the alert system was not designed to understate. Wycliffe Commonwealth was losing its largest commercial relationship in the district. The annual account management fees alone represented a six-figure revenue line. The payroll contract that had been on the table was now formally withdrawn, which meant no access to the deposit and transaction activity of 2,000 employees. 2 real estate development projects the bank had expected to finance were out of reach, and the signal to institutional investors that the bank had mishandled a strategic client relationship through documented branch-level misconduct was the kind of thing that showed up in board-level conversations before anyone was ready to have them. Eleanor Wycliffe arrived at the branch before 2 in the afternoon. She came with the bank's lead counsel but did not bring any external press, which was itself a signal of how seriously she was managing the situation. She was 51, composed, and had the specific quality of someone who had grown up inside an institution and was deeply aware that her surname was on the building. She did not look at Todd when she came in. She looked at the security camera housing in the upper corner of the lobby, then at Millie, then at Maren Holt. She asked Maren to brief her privately, and Maren did, in about 8 minutes, outside the branch manager's office. When Eleanor came back out, she walked directly to Todd and asked him 2 questions. The first was whether he had read Caleb Danner's application before acting on it. Todd said he had made a judgment call based on available information. Eleanor asked the second, whether he had physically torn the application in front of the client. Todd said he had removed a document he believed to be non-actionable. Eleanor turned away from him and crossed the floor to where Caleb was standing. She offered a direct apology for what had occurred and asked Caleb to suspend the remaining wire transfers so that a proper internal review could be conducted with full transparency. Caleb said, "You're asking me to trust a process that only started because you saw my balance." Eleanor held his gaze. She did not argue the point. Maren had been pulling data from the regional Fresh Start loan program for the better part of 2 hours, and what she found did not align with anything in the official reports. The bank's internal disclosures stated that the Fresh Start program in the region carried an approval rate above 70%, had served thousands of applicants, and had produced measurable improvement in the credit profiles of the people who used it. The numbers looked like exactly the kind of outcome a community bank was supposed to generate. What the numbers actually represented was something different. At Todd's branch specifically, the audit trail showed that more than 80% of applications involving amounts under $500 from residents of identified low-income zip codes had never been entered into the loan processing system at all. Forms destroyed before entry created no denial record. Without a formal denial, there was no reportable rejection. The approval rate for applications that did reach the system was high, because the applicants who got that far were overwhelmingly people who already had substantial account relationships with the bank and were unlikely to have needed a $50 emergency product in the first place. The commission structure that connected Todd to BrightPath was not labeled as a commission. It appeared in his personal bank records, which Marin could access under the internal investigation authorization Eleanor's office had issued, as a series of consulting fee payments from a financial advisory LLC, registered in a neighboring county. The LLC's operating address was the home of Todd's brother-in-law. Over 26 months, more than 600 individuals had been handed BrightPath cards at the branch. Not all of them had taken out loans, but enough had that the cash flow from consulting payments to Todd over the same period represented a significant secondary income, tied directly to the number of applicants he steered away from the bank's own products. Nathaniel Crowe had received internal compliance alerts about the referral volume 18 months earlier. His documented response was to note that the branch maintained excellent community engagement numbers and that third-party lending referrals were not prohibited by policy. The emails did not mention that the third party was owned by the branch manager's family member. Eleanor sat with her counsel and was told, plainly, what the exposure looked like. A class action suit was possible if the pattern held across the full region. The planned expansion into 3 additional states would face regulatory scrutiny. One advisor recommended containing the event: terminate Todd's employment immediately, offer Caleb a private settlement, retain the data internally until outside counsel could manage the disclosure timeline, and frame the incident publicly as isolated conduct by one employee. Caleb, still in the lobby with Owen, overheard enough of the outline through the partially open door to understand what was being proposed. He walked to the doorway and said that Todd had not destroyed 600 applications across 2 years without someone deciding, each time a report crossed their desk, that the question didn't need to be asked. Avery called while he was standing there. She was 16 and had a school presentation that evening on financial access in low-income communities, and she asked whether her father was going to be there. He said he was still at the bank. She asked if he had gotten his money out yet. He said almost. Then she said, "What about the people who don't have money to get out?" Caleb stood in the doorway for a moment after the call ended. Then he walked back in. Nathaniel Crowe understood by mid-afternoon that the internal audit Marin was building would reach him. He had spent 22 years cultivating a reputation as a conservative institutional steward, and the prospect of being named in a regulatory filing alongside a branch manager who had been routing elderly customers to his brother-in-law's loan shop was not a consequence he was prepared to accept. He called the branch's operations manager and instructed her to flag Caleb's outgoing wire transfers as requiring additional verification under anti-money laundering protocols. The stated rationale was that the volume and timing of the transfers indicated unusual activity and that the authorization chain needed independent review before processing could continue. The real effect was that the remaining transfers, which included a portion of the operational reserve funds and the final payroll account, were now on hold. Caleb's company was scheduled to run payroll the following morning. The hold, if it remained in place overnight, meant 2,000 people would not receive their wages on time. Nathaniel informed Caleb through an intermediary that the hold was a routine compliance measure and would be lifted within 48 to 72 hours. Owen produced the full documentation package within the hour. Source of funds records for every account, annual audited financials for Danner Holdings, 3 years of corporate tax filings, the bank's own account opening documentation from when the relationship was established, and signed statements from the receiving institution confirming that the transfers had been initiated by a verified account holder through standard wire authorization. The documentation made the anti-money laundering justification untenable, and Marin told Eleanor that holding the funds had no defensible basis under the bank's own compliance guidelines. Eleanor instructed the operations team to release the hold. Nathaniel called the operations manager directly and said that the instruction had to come through the regional chain of authority, not the CEO's office. The operations manager, who had never been placed between the CEO and the regional president before, did not know which instruction to follow. Caleb recognized what Nathaniel was doing. He was using the bank's own regulatory framework as a retaliatory instrument, converting a compliance procedure designed to protect customers into a pressure mechanism against the one customer who had refused to be managed. What Maren found when she looked further into Nathaniel's communication history was not subtle. An email sent 14 months earlier from Nathaniel to the branch operations supervisor at Todd's location read, "The recent risk tier applicant volume is better kept off the active file until approved. Retain clean metrics." A second email, sent 8 months before that, referenced a quarterly report in which an internal compliance analyst had flagged the low documentation rate for small-dollar applications at 3 branches, including Todd's. Nathaniel had responded to that analyst's supervisor and asked that the metric be reclassified as an administrative tracking issue rather than a lending performance flag, and that the analyst be reminded of the regional policy on unsolicited escalation. The analyst, a woman named Marjorie Lane, had resigned 6 months after that email was sent. Todd, watching Maren work through the file archive, understood before anyone said it aloud that Nathaniel had no intention of going down alone. Caleb asked Eleanor directly whether she had received any prior report about what was happening at Todd's branch. She said she had not. Maren asked Eleanor's assistant to pull the routing history for all compliance submissions directed to the CEO's office in the previous 18 months. The result showed one submission from Marjorie Lane, time-stamped on a Tuesday morning 14 months earlier, which had entered the executive routing system, been automatically forwarded from the compliance queue to the CEO's mailbox, and then been intercepted at the preliminary sort level before Eleanor ever saw her inbox by an executive filter account managed by the administrative office that reported to Nathaniel's team. The reason code applied to the rerouting was non-credible customer complaint, pending verification. Marjorie Lane had never been a customer. She had been a compliance analyst with 4 years of institutional knowledge and a formal obligation to document what she saw. The report itself was specific. It named the branch. It described the volume of applications not being entered into the system. It outlined the BrightPath referral pattern. It stated that some of the signed release forms handed to customers when they were referred to BrightPath appeared to contain authorizations the customers had not been told they were signing. It noted that employees who had raised questions about the referral practice at the branch level had received low performance assessments in subsequent review cycles. Marjorie had cited the specific federal statutes she believed were implicated and submitted the report through the proper channel. 6 months later, she was gone. Her final performance review, dated 3 weeks before she left, rated her as below expectations in communication and institutional alignment. Eleanor read the report in full, standing at the conference table, while her counsel watched and did not speak. The program named after her family, the one she had described in community presentations as proof that the bank remained committed to the people its founders had originally served, had been converted into a mechanism for identifying vulnerable borrowers and handing them to a predatory lender in exchange for personal payments to the branch manager with the knowledge of the regional president and the institutional protection of a compliance system that had been quietly stripped of its ability to reach her desk. The board reached Eleanor by phone before 5 o'clock. Several members wanted the internal investigation paused and any external disclosures delayed until the bank's legal team had established a controlled response narrative. One member suggested that if the situation became public, it could be framed as a bank that had already identified a problem and was actively addressing it. Provided nothing was said until the bank had completed its own review on its own timeline, Eleanor listened to the entire call. When it was done, she made a counter-proposal to Caleb, a formal apology, a substantial donation to a fund of his choosing, retroactive fee waivers, and a seat on an advisory council. In exchange, The details would remain private for 90 days. Caleb heard the offer and said, "The first time Todd looked at me, I was worth $50. Now I'm worth $60 million. You're still only seeing the number." What happens to the people who were handed business cards for BrightPath last week? Eleanor set the phone down on the conference table. Then she called the bank's regulatory liaison and told her to prepare a voluntary disclosure filing. Her counsel started to object. Eleanor said it was not a discussion. The emergency board session was held at the bank's headquarters, in a room used for quarterly earnings presentations. Caleb had been formally invited, not as an aggrieved client but as the central figure in what the board's governance committee had classified as a material risk event. Nathaniel Crowe appeared by video from a conference room in the regional office, and he spent the first 12 minutes constructing a portrait of Caleb as a businessman who had deliberately staged a confrontation, using the loan application as a provocation, who had used financial leverage to intimidate branch personnel, and who was extracting maximum institutional damage in retaliation for a minor misunderstanding. He suggested the appropriate response was a formal grievance process and an independent mediator, rather than an internal audit that could prejudice the outcome before facts were established. One board member asked Caleb directly why a person of his financial standing would apply for a $50 product designed for low-income borrowers. Caleb explained, from the beginning, without raising his voice, the bank had asked Danner Holdings to become a distribution partner for the Fresh Start program, meaning the bank's name and products would be introduced to over 2,000 of his employees: mechanics, drivers, warehouse workers, logistics coordinators who earned hourly wages, and for whom a $50 shortfall could start a cascade. Before putting his company's reputation behind that introduction, he had come in as one of those employees to see what the experience actually was. The boardroom was quiet. Marin then presented the documentation in sequence. The security footage from the lobby showing Todd tearing the application without opening it, visible from 2 camera angles. The waste bin contents photographed and cataloged. 31 discarded application forms from the previous 4 business days, all containing personal information, none entered into the loan management system. The 614 BrightPath referrals over 26 months reconstructed from the data. The consulting fee stream to Todd's brother-in-law's LLC. The email chain involving Nathaniel and his instruction to reclassify the compliance flag. And the routing record showing Marjorie Lane's report being intercepted before it ever reached Eleanor's desk. Joanne Bell appeared by video from her home and described her experience clearly and without emotion, which made it considerably more difficult to dismiss. Owen confirmed that 11 of the 12 accounts had been closed and that the final transfer was pending the release of the hold Nathaniel had placed. A board member asked Nathaniel on the video screen to explain the basis for that hold. Nathaniel said it was a standard protocol. The board member asked whether the protocol had been applied to any other client relationship that day. Nathaniel said he would need to check the records. Todd, sitting across the room from Caleb, said that he had made difficult judgment calls in a high-pressure environment and that he had always believed his job was to protect the branch from clients who would create problems. He said Caleb was destroying his career over a piece of paper. Caleb looked at him and said, "You didn't lose your career because you tore my form. You lost it because you tore the same form for hundreds of people who had no way to make you feel it." The board voted to suspend both Todd and Nathaniel, pending full investigation. 3 members pushed for the audit results to remain confidential. Eleanor voted against them. The announcements came within a week. Todd Vickers was terminated. Nathaniel Crowe was suspended and his contract ended 30 days later after the regulatory filing generated a formal inquiry. The case materials were transferred to the State Banking Authority and the Federal Consumer Financial Protection Office, which opened a separate examination into the BrightPath referral network and its compliance with disclosure requirements. The Fresh Start program was suspended across all branches pending a third-party audit of application processing practices. Every individual who had been referred to BrightPath from any branch in the regional system over the previous 3 years was to be contacted directly, informed of their right to file a complaint, and offered access to a remediation fund established to cover demonstrably unfair fees or interest charges. Marjorie Lane received a written apology from Eleanor personally and was offered a consulting role advising the redesign of the internal compliance submission system. She accepted. BrightPath Emergency Lending was placed under investigation for deceptive lending practices, unauthorized use of customer data, and charging rates that exceeded state-regulated limits in 2 categories of short-term loans. Eleanor offered to restore all 12 of Caleb's accounts, waive fees retroactively, add enhanced treasury management services at no charge, and make a multi-million-dollar contribution to the Rebecca Community Foundation. Caleb told her the money was not the question. He said a bank could not purchase a restoration of trust using the same instrument it had just used to demonstrate its absence. He agreed to participate in an independent oversight council for 6 months, with no compensation for his time, and to evaluate whether the bank's operational changes justified a return of his business. But he would not transfer funds back to a system that had not yet demonstrated it was genuinely different from the one that had handed Joanne Bell a BrightPath card. Several board members raised the possibility of formalizing Caleb's advisory role with a retainer. He declined the payment and said the bank should take whatever sum was attached to that offer and add it to the remediation fund. He then outlined what a genuine remediation program needed to include: full written explanations for every loan denial, no referral arrangements between employees and external lenders without full institutional disclosure, transparent approval rate data broken down by income level and zip code published on a quarterly basis, and a frontline training program that treated every applicant as a person entitled to a complete and respectful process, regardless of the amount they were requesting. Owen documented the list and submitted it formally through Marin's office so it would enter the compliance record. Caleb signed nothing that day and took nothing home. He did not seek any public statement. He did not speak to the press. He drove back in his truck to the warehouse project on the eastern edge of the city, where the crew had finished replacing the loading bay flooring, and he walked through the space to look at the work. He stood in the finished bay for a few minutes before heading home to where Avery was already back from school, and when she asked how it had gone, he said, "The account's words closed, and the people responsible were no longer in their positions." She asked whether that was enough. He thought about it. He said it was a beginning. 6 months passed. Danner Holdings did not return to Wycliffe Commonwealth Bank. Caleb had moved the company's primary banking relationships to a regional community lender that had been operating in the district for decades, and whose loan approval data, when his team reviewed it before the transition, reflected the actual population it served. The Rebecca Community Foundation, separately funded and independently governed, launched a small-dollar lending program in partnership with 2 neighborhood credit unions. It was called the Danner Second Step Fund. The program offered loans from $50 to $1,000 at rates disclosed in plain language on a single page, with no prepayment penalties, no vehicle or home required as collateral for amounts under $500, no referral arrangements with any external entity, and a written explanation provided to every applicant regardless of the outcome, approved or denied. Every person who walked through the door received a document explaining what had been considered and what the next options were. Joanne Bell became a community advisory member for the program. Her role was to review the language in client-facing documents and flag anything that a person unfamiliar with financial terminology might misread or miss entirely. She took the position seriously and came to every meeting prepared. On the day the program officially opened, Caleb arrived early and stood near the back of the room. He was wearing the same jacket he had worn to Wycliffe the morning the form had been torn. He had not replaced it because it was still functional, and because he genuinely did not think about his clothing as a statement. He watched a man in his late 60s, a retired small-engine mechanic named Wallace, come through the door and sit down across from a loan counselor. Wallace wanted to borrow exactly $50 to replace a set of calibrated wrenches that had been stolen from his car, tools he used for the part-time repair work that kept his income above the line where things became precarious. The counselor read every page of Wallace's application. She explained each term, asked whether he had questions, and answered without impatience when he asked about the repayment schedule. The conversation took 11 minutes. Wallace signed the agreement, received his copy, and stood up to leave. He looked at Caleb on the way out and asked whether he worked there. Caleb said no. He said he just wanted to make sure nobody had to prove they were wealthy before someone decided to treat them like a person. Wallace nodded as if this were a reasonable thing to want, pushed the door open, and left. At the counselor's station, the signed application rested in the intake folder, complete, undivided, treated with the care that every name on every form had always deserved.